Hello, this is Peter Quinn with Kidder Matthews in San Diego. I'm joined today by Jamie Dick. Jamie heads up our debt and equity practice, and he works nationwide. Jamie, welcome.
Thank you. Happy St. Patrick's Day. Notice the
Happy
green.
St. Patty's Day to you.
No
My
pinching me.
apologies
I
for
got
not
green
having
on.
green on. Although, for those who are noticeable, my eyes are green, so
Oh, oh well,
I get a pass.
no comment on that. So,
Jamie, let's go over what's happening in financial marketplaces today and what our clients are or should be looking for.
well, probably the most. Good morning, Peter, and everyone else. Probably the most important comment I'd make is that rates are stable. And when I say that, interest rates, 10-year Treasury, SOFR, indexes, but maybe more importantly, lender rates, all-in rates that they charge when people borrow money are stable and have been stable for about 6 months. And in fact, you could say the lender rates have been more stable than the national interest rate indexes. They're going to go up and down every day. That's not the case with lenders, and they've kept their rates pretty stable, and I should
Jamie,
say very stable.
Jamie, why is stability important?
Well, because as the old adage goes here in my business, low rates are obviously better than high rates. But what everyone really wants in our business, almost regardless of what you do, are stable rates. Because when rates are stable, people can get their arms around a deal and make a decision of whether to buy or sell and transact. And that's really, and we're seeing that with increased activity, both in the investment brokerage, people buying and selling properties, but also people financing.
Any particular product type where we're seeing more or less activity?
I'd say if you're going to pick one type of lending that's very, very active compared to others, it'd probably be bridge loans. You have a lot of people who have loans that are coming due, also have a lot of people trying to buy properties that may need a little work before they stabilize them, and bridge loans are really directed toward that. There's kind of a static number of permanent loan lenders, life insurance companies, CMBS lenders, banks, credit unions, but there's been an ever growing number of bridge lenders, many of them private funds that are looking for higher yields and are willing to do more flexible short-term financing.
Any product types that bridge loans favor?
Pretty much runs the same gamut as you see for permanent loans. Apartments are always number one. Every lender likes that. They feel most comfortable. People got to live someplace, so you kind of have the demand side down. The supply side's the question. Industrial, very similar. Not a whole lot of development of industrial. It's hard to find land that works, and so you've got good supply demand economics and low vacancies accordingly. But so in order, it'd be multifamily residential, second industrial, third would be retail, which has had a strong comeback from the pandemic days. 5 years anniversary right now, time flies, and then of course office is still a big question mark, though you're seeing more people going back to the office.
What do you predict is going to happen in Q2 2025?
Well, this is crystal ball stuff, and I always love my predictions, no matter how bad they are. But I think, quite frankly, I try to be level-headed about things like this when you're looking at the crystal ball. But I think that my opinion is that tariffs are bad. I think it slows down the economy, and I think there's a chance that we start inching toward a recession, quite frankly, which is ironically in my business of being in the debt business is good because rates come down when you have a slowing economy. We might have an odd situation that's happened before where interest rates come down because of a recession, and suddenly activity picks up. My old joke is every morning I wake up hoping for a recession everywhere except where I am. So interest rates will come down, but we'll see.
I'm sure that is everybody votes their own pocketbook. That's for sure.
Absolutely.
Anything that you want to talk about locally? Are you seeing recovery in Southern California that is on pace with other markets around the country?
Southern California is a San Diego, Orange County, Los Angeles. Those are mature commercial real estate markets. And I mean, San Diego, where I live and have for a long time, though we've worked with our clients nationwide, we kind of ran out of dirt to build things about 10 years ago, if you really look at it. And so you don't see the wild fluctuations in vacancies and occupancies and just in general. You go to other markets that aren't as mature and take two in declining order, if you will. Phoenix still has a lot of land. You can build a lot of things and create a lot of vacancy really fast. And they have, especially in the last 12, 18 months in the industrial sector. And then Las Vegas. Las Vegas is growing. You take a look at it over the last 10, 15 years, growing at a very, very fast rate, but there's a lot of land there. So somebody can build something right next to you, and suddenly you've gone from being a prince to a pauper as an owner.
Jamie, hey, thank you very much for this financial market update. Jamie Dick is Senior Vice President and shareholder at Kidder Matthews here in San Diego. Remember that Jamie covers all commercial marketplaces nationwide. His information will be at the bottom of the screen as you're watching this. This is Peter Quinn with Kidder Matthews, San Diego. Thanks, Jamie.
Thank you.